Welcome to Unit 8, Source Documents. The objectives of Unit 8 are to be able to identify and record source documents. Students will understand that a source document is prepared for every transaction. Students will be able to describe the principle of objectivity. Students will understand that source documents are pre-numbered and that all source documents must be accounted for. First of all, let's talk about what is a source document. It's any business form that serves as the original source of information that a transaction has occurred. This is proof, physical proof, that a transaction has actually occurred. A source document is generally prepared with at least 2 copies. One copy is given to each of the 2 people involved in the transaction, which is the buyer and the seller. The first type of document that we're going to talk about is the cash sales slip. It's prepared for all cash transactions, all cash sales by a business. We will not be journalizing or posting GST until later in the course, so we won't be concerning ourselves with GST and PST. 3 copies of a cash sales slip are prepared when a cash sale is made. 1 copy is for the buyer. 1 copy is for the seller to record the transaction, and 1 is for the cash sales file where all cash sales slips are stored. Here's an example of a cash sales slip from the textbook. Notice, in this particular example, we have a cash sales slip number. Now these numbers, depending on the business, can be located anywhere, so you have to look around. Sometimes they're in the bottom left, sometimes they're in the top left, top right, bottom right. The next type of document is the sales invoice. Sales invoice is a bill of sale or a bill. These are other names for it. It's completed by the seller and given to the buyer. The sales invoice is a record of a credit sale where the customer agrees to pay at a later date. Please don't get this confused with a cash sales slip. Sales invoices are for when we have a credit sale. Credit sales can also be called charge sales or sales on account. The selling company makes several copies of the sales invoice for the following. Copies 1 and 2 are sent to the customer. Copy 3 is used by the seller's accounting department as a source of information to record the transaction. This allows them to keep track of the transaction so that they understand and they follow up on whether or not the buyer is going to pay on time. Copy 4 is kept by the sales department as a record of the sale. Here's an example of a sales invoice from the textbook. Notice in this case, the invoice number is in the top left-hand corner. We have 4 copies. 1 for the customer, which they can keep. Number 2 is for the customer that they probably will send back when they make their payment in the agreed upon time. 1 is for the accounting department, and 1 is for the sales department. Now, when we have sales invoices, we have different entries depending on your perspective. You have a buyer's entry and you have a seller's entry, so you have to keep those in mind. What is the journal entry from their perspective? So the buyer's entry for a sale, in this case consulting services expense, $2,354 is what they paid for this consulting. And they agreed to pay at a later date, so the accounts payable account for Sani Consulting goes up by $2,354. And in the description, we note the purchase invoice number. Now the seller has the exact same transaction to deal with, but they have a different perspective. They have an accounts receivable to Warren and Sports for the same amount, $2,354. And they have revenue, which they have called consulting revenue, for the same amount. And their sales invoice is $5,870. Notice that the buyer calls it a purchase invoice and the seller calls it a sales invoice. It's the same document, but it's just based on their perspective. The seller's accounting department's entry is accounts receivable for Warren and Sports and consulting revenue. This is where they note that there's an invoice that was sent out, and the details on that is it must be paid in full within 30 days. A purchase invoice is the bill received by the purchaser as a proof of a purchase on account. Uses the same documents as the source document that came from the selling company. The sales invoice provided by the selling company acts as a purchase invoice for the buying company. So one company calls it a sales invoice, the other one calls it a purchase invoice. So please don't get these confused. Always remember whose perspective you are looking at. The entry for a purchase invoice is, in this example, training expense, and accounts payable is the credit. Purchase consulting services with invoice $5,870, net 30 days. So you know that you have 30 days to pay this in full. Another type of source document is a check. Checks are issued to make cash purchases and to pay bills. A check consists of two parts, the check itself and an attached portion that provides the details to explain why the check was written. We sometimes call this a check stub. The check is given to the seller. Here's an example of a check. Notice the section at the top is the check itself that is sent to the seller, and the portion at the bottom is the attachment used by the buyer to prove that the check was sent, and it has all the details. It has the date, the invoice number that it was paying, the amount, and any discounts, which in this case there aren't any. The entry for issuing a check is accounts payable to Sonny Consultants goes down $2,354, and cash also goes down by the same amount. Notice in the description we have to indicate the number of the check that was sent and the number of the invoice that was paid. On the other end, we have to note what kind of journal entry is required for checks when they are received. It's separated from the attachment, the check is, and the check is endorsed for deposit only. Endorsed simply means signed by someone who represents the company and taken to the bank and deposited. A restrictive endorsement is used to control what will happen to the funds from the check. So this is an endorsement that implies that something special has to happen. In most cases, it's to be deposited into the account only, and no funds can be taken out. The check is deposited in the selling company's bank account after the endorsement. The entry for the check for the selling company is as follows. Cash is received, $2,354, and the accounts receivable for the company is reduced by that same amount. The received check number is noted, and the invoice that it paid is also noted. There's another source document called a list of checks received. This is for companies that have many checks that come in on a particular day, and instead of dealing with each one individually, a list is created to help make the deposit easier. company takes the checks to the bank where they are deposited, and then the journal entries are prepared. This ensures that the checks are not misplaced and the check information is listed all in one place. The checks are deposited promptly and not left around where they can easily be lost. Bank source documents are documents that need to be discussed. One is called a bank credit memo. This is a document to show that interest or other amounts have been added to the company's account. So this is the bank saying, you have money that you have deposited in our account and we have been using it and we want to pay you because we used it. Now normally these amounts are very low, probably less than 1%, but they are still added to the business bank account by using a bank credit memo. The other type of source document from a bank is called a debit memo. This is a document that shows that interest or other amounts have been deducted from the company's account. So because you have a bank loan out and interest has to be charged on a monthly basis, this document says that yes, we have added interest to your account, or we have taken interest away from your account to pay for the interest. Here are some facts about source documents. They need to be pre-numbered. That's to make them unique, and so we can keep track of them and keep them in order if we need to. They must be accounted for, and the numbering makes them unique. Prevents errors and losses due to thefts by employees or other people, or someone trying to create false documents to prove that transactions occurred. Source documents are filed and used by the owners and managers of the business, outside accountants hired to check records when they perform audits, federal income tax and GST personnel from the government, Canada Customs and Revenue Agency, better known as CCRA, and provincial sales tax and Ministry of Labor personnel. And from time to time, officials of the court may need to use source documents. Source documents are evidence that transactions have occurred. This is the definition that we told you at the beginning. Companies must be able to prove that transactions have happened, and source documents are the way they do it. They can be verified by comparing source documents of the buyer and the seller, which must be in agreement. Now we have to learn a new principle called the principle of objectivity. The principle of objectivity states that, and it requires that, accounting records must be based on objective evidence to support the value used to record transactions. And the objective evidence is source documents. They provide objective, verifiable evidence to support the value placed on transactions. Your assignment today is to complete questions 19 and 20 on the web and complete exercise 10 on page 144 of the textbook, and you need to use several pages in the workbook. This is an extremely long assignment and will probably take the rest of this class to complete and one more class.